Friends, thank you for being here today. I want to ask you something that might sound at first like a simple question. What if a country could get richer and poorer at the exact same time? What if the headline numbers, the ones plastered on government press releases and broadcast on the evening news, were telling you one story, while the reality underneath your feet was telling you an entirely different one? What if the economic growth you have been hearing about for years was, in fact, a carefully constructed illusion, not driven by innovation, not driven by productivity, not driven by the sweat and ingenuity of a nation becoming more capable, but simply by adding more people to the count? That is not a conspiracy. That is a stated policy. And today, friends, we are going to pull back the curtain on it. We are talking about Canada, and we are talking about a number that should stop you cold. When you measure Canada's economic output, its gross domestic product, it has been growing. Year after year, the aggregate number ticks upward. The government points to it. The central bank references it. The headlines celebrate it. But here is what they are not telling you. When you strip out population growth, when you divide that GDP by the number of actual people living in that country, the picture does not just look different, it collapses. Canada has experienced one of the longest per capita GDP stagnation periods in decades. In multiple recent quarters, per capita growth was not just weak, it was negative. The average Canadian, in real inflation-adjusted terms, has been getting poorer. This is not a market correction. This is not an adjustment. This is a structural fault line running directly beneath the foundation of an entire economy. What we are witnessing is not a blip. It is a slow motion unraveling that has been building for years, and the window to understand it and to protect yourself from its consequences is vanishing in real time. Now, to understand how we arrived here, we cannot start with last quarter's GDP report. That is not how you find the truth. You have to go to the origin. You have to go back to the architecture of the system itself, because what is happening in Canada today is not an accident. It is the final act of a very long tragedy, one that was written decades ago. Think about what an economy is supposed to do. At its most basic level, it is a machine for turning human effort and ingenuity into a better standard of living. When an economy is genuinely healthy, productivity rises. That means each hour a worker puts in produces more output than the hour before. It means businesses invest in better tools, better technology, better processes. It means real wages climb. It means a family can, over time, afford more on the same number of working hours. Productivity growth, economists will tell you, is the single most important driver of long-term living standards, not population growth, not government spending, not immigration numbers, productivity. And this is the system's most crucial secret, which we will explore in depth shortly. Canada, for much of the latter half of the 20th century, rode a wave of commodity wealth. Oil from Alberta, timber from British Columbia, potash from Saskatchewan, wheat from the prairies. The country was sitting on a geological fortune, and for a time that fortune masked a deeper structural weakness. Canada was never forced to build the kind of innovation-driven, capital-intensive, technology-forward economy that its neighbors to the south were constructing. The United States, whatever its flaws, built Silicon Valley. It built a venture capital ecosystem. It built the pharmaceutical industry, the aerospace industry, the semiconductor industry. Canada built pipelines and condos. Think of it like this. Imagine two neighbors on the same street. One of them inherits a gold mine in his backyard. He extracts the gold, sells it, lives comfortably, and never particularly bothers to learn a new skill or upgrade his tools. The other neighbor has no gold mine, so he goes to school, learns engineering, invests in machinery, starts a small manufacturing firm, and over 20 years becomes genuinely more productive, more capable, and more wealthy per hour of work. Now imagine the gold starts running out or the price of gold drops. The first neighbor, the one who never invested in productivity, suddenly finds himself in a very uncomfortable position. His standard of living was never as solid as it appeared. It was always resting on extraction, not on the compound growth that comes from genuine productive capacity, that is, Canada. And the gold in this metaphor is not running out, but something else is happening that is equally destabilizing. The population is growing faster than the economy can productively absorb it. Canada has one of the fastest population growth rates in the entire developed world. Immigration has been running at historically unprecedented levels. And here is the thing that the simple logic of more people means more growth completely fails to account for. Population growth inflates the aggregate GDP number without necessarily raising the output per person. You add 1 million people to a country, GDP goes up because there are more hands working, more mouths spending. But if those hands are not equipped with better tools, better technology, better infrastructure, the output per worker does not rise. It stagnates or it falls. And that is precisely what has been happening. Business investment per worker in Canada has lagged behind the United States for years, not slightly, measurably. Consistently, Canadian firms have invested less in advanced machinery. They have invested less in automation. Technology adoption rates trail global competitors. The venture capital ecosystem, while growing, remains small relative to GDP when compared to major technology economies. Research and development spending by corporations remains modest. And in a perverse twist that gets to the heart of this crisis, enormous amounts of capital, the savings and investment dollars that could have been flowing into factories, into software companies, into medical technology, have instead been flowing into one place, housing. Canada's real estate market has been one of the most extraordinary asset bubbles in modern economic history. Toronto and Vancouver have ranked among the least affordable housing markets on the planet for over a decade. And when capital pours into housing, it does not produce productivity. A condominium tower in downtown Toronto does not invent anything. It does not manufacture anything. It does not export anything. It simply stores wealth in concrete and glass, inflating balance sheets while the productive engine of the economy quietly rusts. This is what I call the big secret of the entire system. The headline growth was never real growth. It was extensive growth, the kind that comes from adding more inputs, more people, more square footage, rather than intensive growth, the kind that comes from doing more with the same inputs. And the difference between those two types of growth is the difference between a nation that is genuinely becoming wealthier and a nation that is performing the theater of wealth while the foundation silently crumbles. The Bank of Canada knows this. The Organization for Economic Cooperation and Development has flagged it. Academic economists have written about it. And yet the policy response has remained year after year to bring in more people, build more housing, and hope that the aggregate number keeps climbing. Because as long as the aggregate number keeps climbing, the political class can claim success. The architecture of this illusion has been built deliberately, brick by brick, and we are approaching the moment when the edifice can no longer hold its own weight. Now, friends, I want you to understand something. Everything I have described so far, the productivity collapse, the immigration inflated GDP, the capital trapped in concrete, that is the background. That is the rot in the walls that you cannot see until the storm hits. And the storm, I want you to understand, has already begun. The trigger is not some distant future event. It is not a forecast. It is not a model projection with error bars and confidence intervals. It is already unfolding in real time in the data that most Canadians are not reading and in the consequences that millions of ordinary Canadian families are already feeling at the kitchen table, at the gas station, and in the grocery store aisle. Let me show you exactly how the unraveling is happening and why it is accelerating. Start with the most fundamental number, real wages. If an economy is genuinely growing, real wages adjusted for inflation, should be rising. Workers should be able to afford more over time. That is the entire promise of a modern market economy. That is the contract. And in Canada, that contract has been broken. Real wages have struggled to keep up with inflation for years. The average Canadian worker is producing less output per hour than peers in several comparable OECD economies. Think about what that means in human terms. It means you are working just as hard, perhaps harder, and your paycheck buys you less. You are running on a treadmill that is slowly accelerating, and the destination is not prosperity, it is exhaustion. This is not a conspiracy. It is a mathematical reality. And the mathematics, once you see them, cannot be unseen. Now, here is where the situation graduates from troubling to genuinely alarming, because productivity stagnation does not exist in isolation. It is not a sealed chamber. It bleeds into everything. It bleeds into government revenue. When workers are less productive, when businesses generate less real output per unit of input, the tax base grows more slowly than the political promises made against it. Infrastructure crumbles, public services strain. Governments, faced with the choice between cutting spending and borrowing more, almost always choose to borrow more. And Canada has been borrowing. But here is the deeper problem, and this is the linchpin of everything I am about to show you. Canada's economy is not just suffering from a productivity gap. It is facing a convergence, three distinct fault lines pulling in three different directions simultaneously, and the combined stress on the structure is approaching a breaking point. The first fault line, per-capita GDP, has been in effective decline. The second fault line, housing has absorbed the capital that should have built the productive economy. And now that housing market is under severe pressure as interest rates have risen dramatically from their historic lows. The third fault line, rapid population growth, has strained housing, infrastructure, and public services to a degree that is generating social friction, political instability, and economic inefficiency all at once. Three forces converging now. And here is what makes this so dangerous. Each of these fault lines would be manageable in isolation. An economy can recover from a productivity slump if it redirects capital toward investment. A housing correction can be absorbed if the underlying economy is strong. Population growth can be a genuine asset if it is matched with the infrastructure and job creation necessary to make it productive. But when all three hit simultaneously, when the productive engine is stalling, the capital is locked in depreciating real estate, and the population continues to grow faster than the system can absorb. You do not get a manageable correction. You get a structural break. Let me show you the canaries. Because in every financial crisis, there are always canaries, small, specific, seemingly isolated signs of failure that the financial press dismisses as anomalies right up until the moment they are not anomalies at all. They are the first visible cracks in the edifice. Watch the Canadian consumer. Household debt in Canada has been for years among the highest in the developed world relative to disposable income. Canadians borrowed massively against their homes, against their future earnings, on the assumption that the housing market would continue to rise, that rates would stay low, that the good times were structural rather than cyclical. That assumption is now being tested in the most brutal possible way. As borrowing costs have risen, the debt service burden on Canadian households has exploded. Families that could afford their mortgage at 2% are now renewing at 5, 6, 7%. The difference is not marginal. For many households, it is the difference between solvency and the slow suffocation of financial distress. And watch the commercial real estate sector. Across Canadian cities, office vacancy rates have reached levels not seen in a generation. The post-pandemic shift to remote and hybrid work has hollowed out downtown cores, leaving behind empty towers that were financed with debt and are now generating a fraction of the rental income that was projected. When commercial real estate loses value, the banks that lent against it take losses. And when banks take losses, they tighten credit. And when credit tightens, the businesses that depended on that credit to make payroll, to carry inventory, to fund expansion, suddenly find themselves squeezed. Liquidity drains, the tide goes out, and we find out who is swimming naked. Now, some of you are thinking this is serious, but surely it cannot spread beyond the real estate market. Surely the broader economy is insulated, and I want to address that directly because this is precisely where normalcy bias becomes the most dangerous cognitive trap of all. The Canadian banking system is highly concentrated. 5 major banks dominate the market in a way that has no real parallel in the United States, where thousands of regional and community banks distribute the risk. In Canada, when the 5 big banks are exposed, and they are exposed through their mortgage books, through their commercial lending, through their capital market activities, there is no distributed buffer. The concentration that made Canadian banking look stable and prudent during the 2008 financial crisis, because Canadian banks were not running the same kinds of exotic derivatives books as their American counterparts, is now a vulnerability, because the risk is not in derivatives. The risk is in the mortgage market itself, and the mortgage market in Canada is enormous relative to the size of the economy. Consider the scale. Canadian household debt to GDP has been running at levels that rank among the highest in the developed world. When you have that level of leverage sitting on top of a housing market that inflated dramatically over a decade of near zero interest rates, and then you raise rates aggressively, you are not making a small policy adjustment. You are stress testing an entire societal balance sheet. And here is the forensic detail that most commentators will not give you. because it requires you to look beyond the headline numbers into the actual mechanics of the system. The mortgage renewal cliff. In Canada, unlike the United States, where 30-year fixed-rate mortgages are standard, the majority of mortgages are short-term fixed, 5 years or less. That means that even households who locked in at low rates during the 2020 and 2021 boom are now approaching their renewal date. When they renew, they will do so at rates that are dramatically higher than what they originally signed. The Bank of Canada has estimated that the average monthly payment for renewing borrowers will increase by hundreds of dollars. For many households, this is not an inconvenience. It is a financial earthquake. Think about what that means in aggregate. Millions of Canadian households simultaneously facing payment shock. Consumer spending, which drives a significant portion of Canadian GDP, contracting as that money is redirected to debt service. Retail sales weakening, restaurant closures, small business stress. The productive economy, already limping from the productivity collapse we described, now facing a demand shock from above. Stocks. The Toronto Stock Exchange is heavily weighted toward financials and energy, the banks and the oil companies. If the banks are under pressure from mortgage losses and the energy sector is facing commodity price volatility, the index is exposed on both of its primary pillars. The liquidity that supported Canadian equities through the era of easy money is draining as rates stay high, and global capital seeks higher returns elsewhere. Bonds? Canadian government bonds, the supposed safe haven, are facing their own pressure. When a government runs persistent deficits to fund spending promises made during an era of cheap money and then finds itself refinancing that debt in a higher rate environment, the interest cost explodes. The fiscal architecture that was built for a world of 2% rates does not simply scale to a world of 4 or 5% rates. It fractures. The math is not subtle. It is not ambiguous. It is a structural fault line built into the sovereign balance sheet. And cash? Inflation has eroded purchasing power. The money illusion, where you see the number in your bank account staying the same or even growing while your actual purchasing power quietly evaporates, is perhaps the cruelest trick the modern financial system plays on ordinary people. You become wealthier on paper and poorer at the grocery store. The number grows, the reality shrinks, and most people, because they are looking at the number and not the reality, do not notice until the damage is already done. Liquidity is draining, the scaffolding is under stress, and we are about to find out who built their house on sand. Friends, I want to pause here for a moment because everything I have shown you so far, the productivity collapse, the mortgage renewal cliff, the liquidity drain, the sovereign debt pressure, all of it points to a single unavoidable conclusion. And I want to make sure you hear it clearly because it is the kind of conclusion that the financial media will not state plainly, and that the political class has every incentive to obscure. Canada is not facing a cyclical downturn. It is not facing a temporary rough patch that a rate cut or a stimulus package will smooth over. It is facing a structural reckoning, the inevitable consequence of an economy that chose the appearance of growth over the substance of it, that chose to count heads instead of building capacity, that chose to inflate asset prices instead of investing in productive capital. The bills for those choices are arriving now, all of them, at the same time. We are facing a convergence, a trifecta of structural pressures that are not taking turns. They are arriving together. First, The productive engine of the Canadian economy has been stalling for years. Per capita GDP growth has been negative or negligible. Real wages have been eroding. Business investment per worker has lagged. The foundation of genuine long-term prosperity, productivity, has been quietly collapsing beneath the surface of a headline number that was kept artificially inflated by population growth. Second, the capital that should have been building that productive engine was instead absorbed into the most unproductive possible use, residential real estate. And now, as interest rates have corrected from their historic lows, the leverage that inflated that real estate market is becoming a weapon pointed directly at the household balance sheets of millions of ordinary Canadians. The mortgage renewal cliff is not a hypothetical. It is a scheduled event, and the payment shock it delivers will ripple through consumer spending, through retail, through small business, through the banking system itself. Third, the social and political costs of rapid population growth without matching infrastructure investment are now arriving in the form of housing unaffordability at levels that are generating genuine social anger, in the form of strained public services, in the form of a political environment that is increasingly unstable and reactive. Political instability is not a soft qualitative concern. It has direct economic consequences. Investors do not put long-term capital into economies where the policy environment is uncertain and the social contract is under visible strain. Three forces converging already in motion. And yet, and this is the most important thing I will say today, the vast majority of Canadians are not prepared, not because they are unintelligent, not because they are careless, but because of something hardwired into the human mind that economists and psychologists have studied for decades, and that I believe is the single greatest financial threat most people will ever face. It is called normalcy bias. Human beings are not wired to anticipate structural change. We are wired for pattern recognition. We are wired to look at what happened yesterday and assume it is the most reliable guide to what will happen tomorrow. For most of human history, that was a perfectly functional cognitive strategy. The world changed slowly. Seasons were predictable. Harvests followed patterns. But in a modern financial system, where decades of accumulated imbalances can resolve themselves with terrifying speed, normalcy, bias is not a survival tool. It is a vulnerability. Think about what normalcy bias looks like in practice right now. It looks like a Canadian homeowner who knows intellectually that their mortgage is renewing at a higher rate, but who has not yet fully reckoned with what that means for their monthly budget, because every time they have faced financial pressure in the past, something has come along to ease it. Rates came back down. The government stepped in. The housing market bounced. And so the brain files the current warning under the same category as all the previous warnings that turned out to be manageable. It assumes continuity. It discounts discontinuity. And discontinuity, friends, is precisely what structural breaks deliver. There is a companion to normalcy bias that I want you to understand, because it operates at the same time and compounds the damage. It is called the money illusion. And it is, in my view, the most elegant and devastating trick that a fiat monetary system plays on the people living inside it. The money illusion works like this. You see the number in your bank account. The number is larger than it was 5 years ago. Your salary is nominally higher. Your home on paper is worth more than you paid for it. Every visible metric suggests you are wealthier. And yet at the grocery store, the same basket of food costs dramatically more than it did 5 years ago. The same tank of gas, the same utility bill, the same insurance premium. Your number went up, but your purchasing power went down. You became a millionaire on paper and poorer in reality. And because the brain anchors on the visible number, because the number is concrete and the erosion of purchasing power is invisible and gradual, most people do not feel the wealth destruction until it has already happened, until the damage is already baked in. This is not a glitch in the system. This is a feature of a monetary architecture that was designed, whether intentionally or as an emergent property of its incentives, to allow governments and institutions to effectively default on their obligations in all but name. When a government borrows at 2% and then inflation runs at 6%, the real value of that debt is being inflated away. The lenders, the pension funds, the bondholders, the ordinary savers are being paid back in dollars that buy less than the dollars they lent. It is a default in all but name, and it has been the preferred mechanism of sovereign debt management for the better part of a century now. Given all of this, given the productivity collapse, the leverage trap, the mortgage renewal cliff, the normalcy bias that keeps most people from acting, and the money illusion that keeps most people from even perceiving the problem clearly, I want to ask you the single most important question in personal finance. Do you own assets, or do you own claims on assets? This distinction sounds academic. It is not. It is the difference between surviving a monetary reset and being destroyed by one. Let me explain it simply. A stock in a Canadian bank is not a hard asset. It is a claim on the earnings of an institution that is itself leveraged against a mortgage market that is under structural stress. An ETF tracking Canadian equities is not a hard asset. It is a claim on a basket of claims, mediated by financial infrastructure that, in a genuine liquidity crisis, can freeze, gap, and fail to deliver the value you believed you held. A savings account denominated in Canadian dollars is not a hard asset. It is a claim on a central bank that has a mandate and a mechanism to inflate the currency it issues. Gold is a hard asset. It is not a claim on anything. It does not require a counterparty to honor an obligation. It cannot be printed. It cannot be diluted. It has functioned as a store of value across 5,000 years of monetary history. Through the collapse of the Roman denarius, through the failure of John Law's Mississippi scheme, through the Weimar hyperinflation, through the breakdown of Bretton Woods, through every sovereign debt crisis and currency debasement that history has recorded, not because gold is magic, but because gold is the one monetary instrument that exists entirely outside the architecture of paper promises. Silver carries the same fundamental properties and has the additional characteristic of being deeply embedded in industrial supply chains, which gives it a demand floor that is independent of purely monetary demand. When the monetary system comes under stress, silver does not just benefit from flight to safety. It benefits from the fact that the world literally cannot build solar panels, medical equipment, or electronic components without it. Land. Productive agricultural land, in particular, is perhaps the most fundamentally real asset a human being can hold. It produces food. Food is not optional. Food is not a financial instrument. A farm in the Canadian interior that produces wheat or canola does not care what the Bank of Canada does with interest rates. It does not care what happens to the Toronto Stock Exchange. It does not carry counterparty risk. It does not require a financial institution to intermediate its value. It is, in the most literal possible sense, real. The question is not whether you believe in gold. The question is not whether you are optimistic or pessimistic about Canada's economic future. The question is this: in a world where the paper architecture is showing visible stress fractures, where the productivity foundation is crumbling, where the leverage is extreme, where the monetary system is being asked to paper over structural problems it cannot actually solve, what is the ratio of real to paper in your personal financial life? If the answer is that almost everything you own is a claim on something rather than something itself, if your wealth exists primarily as numbers on screens, as ETF units, as bank deposits, as equity in a leveraged property, then you are inside the system. And being inside a system that is under structural stress when you have no position outside of it is not a diversification strategy. It is concentrated exposure to a single thesis that the paper architecture will hold. History does not support that thesis over long time horizons. And in Canada specifically, the time horizon may be shorter than most people currently believe. This is not about fear. I want to be clear about that. This is about the oldest principle in risk management. You do not position yourself for catastrophe after it arrives. You position yourself for it while there is still time, while the optionality is still available, while the window is still open. Stepping out of the line of fire is not pessimism. It is the most rational act available to someone who can see where the trajectory leads. Begin simply. Understand the difference between what you own and what you are owed. Understand what in your financial life is genuinely real and what is a paper promise. Begin directing a portion of your savings, not all of it, a meaningful portion, toward assets that exist outside the paper architecture: gold, silver, productive land. Hard things that cannot be diluted, cannot be defaulted on in secret, and cannot be made to vanish when the institutions that create and manage paper wealth come under the pressure they are now visibly beginning to face. And understand this clearly: the time to prepare is not when everyone is preparing. It is not when the newspapers are running front-page stories about the crisis. It is not when your neighbor is asking you where to buy gold because he just watched his portfolio drop 40%. It is now. It is in the quiet before the structure shifts. It is in the period when the fault lines are visible to those who are paying attention, but the collapse has not yet registered on the instruments that most people are watching. Canada's per capita recession is not a future event. It is a present one. The mortgage renewal cliff is not a future event. It is a scheduled one. The productivity gap is not closing. It is widening. The convergence of these three forces is not speculative. It is structural. It is mathematical. It is, in the most precise sense of the word, a singular inevitability, the kind that does not ask for your opinion, does not wait for your convenience, and does not announce itself with courtesy before it arrives. Friends, history has always favored the prepared, not the lucky, not the connected, not the ones with the best forecasting models or the most sophisticated financial advisors. The prepared, the ones who looked honestly at what the numbers were actually saying, who resisted the seduction of the headline, who understood the difference between the illusion of paper wealth and the reality of hard assets, and who had the discipline and the clarity to act while acting was still possible, the window for that preparation is not closed, but it is closing. And the speed at which it closes in a system this leveraged, this structurally stressed, this exposed to the kind of cascading feedback loops that liquidity crises produce, that speed can surprise even the most experienced observers. Do not let it surprise you.